Until we get an agreement between China and the US, we think that US rates are well contained. China is the driver of global growth, and so as we have seen over the last 3 months, we do have a growth deceleration across the world in most PMIs with the exception of the US. When you think about the credit markets, most strategies are really dominated by different factors. So for example, high yield is very dominated by lower quality credit. Investment grade tends to be dominated by rates more than spreads. The advantage of a balanced credit approach is you balance that credit with rates and get the benefit of diversification. So when we look around the world today, if we're going to have a slower growth environment, credit on a global basis can offer very attractive opportunities versus a government strategy or a pure high risk strategy. This balanced approach can lead to more consistent returns, and there's always opportunities in the credit markets on a global basis. Our approach to multi-asset credit really focuses on opportunities that we think are advantageous in today's markets. First, identifying where each country as well as each industry is in its credit cycle. Are we in downturn, credit repair, recovery, or expansion? We want to stay away from countries that are in late expansion, that are going to go into downturn, and we want to take advantage of the other 3 parts of the cycle. So when we think about today's world where central banks are being more accommodative, what this does is extend the credit cycle, which means there's more opportunity in this environment versus many other fixed income investments. Our second key message would be that when we construct a portfolio, not only are we trying to get the best ideas in the portfolio, and we do this through fundamental research of over 55 credit research analysts that go balance sheet by balance sheet, but also what we want to do is we really optimize the portfolio on drawdown management. What WorldCAF does is utilizes multiple credit asset classes: EM, high yield, securitized, bank loans, investment grade. What this allows us to do is manipulate the portfolio to get a higher Sharpe ratio through diversification. So if you're worried that we're going into the drawdown, diversification benefit both on a global basis as well as a credit basis really can add value to your portfolio in terms of drawdown management and diversification. What multi-asset credit approach does is it balances that factor risk between credit risk and interest rate, and it leads to a more all-weather, more consistent return pattern than being dominated by duration or being dominated by very low quality credit. So overall, we think it's a great time to utilize this multi-asset credit approach. You get the benefit of diversification, better drawdown management, lower volatility,